for Nvidia, terminal value, starting in year 6. That's going to be cell B9. That is going to be the key value driver formula. This is our perpetuity formula. Okay. So this is going to be, again, one of the more difficult things you're going to have to do today, which is we're about to take this formula, which is the key value driver formula, and we're going to plug it in to our model for continuing value. So I'm going to take a screenshot of this formula, just see what I'm about to do. And I'm going to put that into our Excel file so that when I go back to Excel, just as a reference, so what I'm doing. This formula is what's going to be in this cell. Okay. Now, because I don't want to actually make changes, and these numbers can change. NOPLAT can change, G can change, RONIC could change, WACC could change. I'm going to actually get the data for this off of the assumptions tab. There's 4 assumptions I need. I already have one. It's called a WACC. The next 4 assumptions. I'm going to need a continuing value, NOPLAT or NOPAT. I'm going to need a continuing value, ROIC, aka RONIC. And I'm going to need continuing value, G. Those are assumptions that could change. So those are all going to be in yellow. Where do I get my continuing value NOPLAT from? Off the assumptions tab. It's going to be in the continuing value formula. So for B5 equals TII, NOPLAT is row 5. The final year is M. So M5 off of TII. Now this gets back to the book. When you value a company, a best practice is you always forecast 1 year more than your year-by-year short-term forecast. So translation, the first 5 years are the year-by-year forecast for Nvidia. Year 6 is the beginning of the continuing value period, right? If we did a 10-year model, we would forecast 10 years, and then we'd have an 11th year, an N+1 year, which basically be the beginning of the continuing value formula. So you always forecast 1 more year than your explicit forecast period. That final year is the beginning of the continuing value. For us, it's 2030. That is what I'm putting in the 2030 NOPLAT for the continuing value as a starting point. What is my 2030 or long-term ROIC as a starting point? Equals economic profit, ROIC, row 16, 2030, M16, 184.5%. G as a placeholder, 3%. We'll talk later about how to estimate a G, but this is the very, very long-term growth rate of the company. And as a placeholder, we're going to put in 3%. The assumption is, as a starting point, most companies tend to grow with the economies when they're mature. Therefore, 2 to 3% is the growth rate of most Western nations. And so we're going to use 3% as a placeholder. But again, we're going to put in a more realistic number for Nvidia a little bit later. So these are the 4 parts of the continuing value formula. We then go to our DCF valuation, and using that formula in cell B9, we're going to start building that formula. So equals left paren, assumptions, NOPLAT, B5, times left paren, 1 minus the growth, B7, divided by the ROIC, B6, right paren, divided by left paren, whack, B4 minus G, B7, right paren, enter. So if those four assumptions come true, they would have continuing value of $54.9 trillion. Clearly, they're a little optimistic. But that's the number that the math would answer for.
Professor, could you?
I already know what the question is going to be. So there's the formula. Leave it on the screen for a second. At least I'm assuming that's what the question is going to be.
You were right.
As I said, this algebraic equation is the hardest thing you got to do tonight. Get that formula right. I get it right about 9 out of 10 times, and I screw it up once. I got to go fix it. But I've been doing this for a while. Questions? This is the continuing value perpetuity for year 6 going into perpetuity. By definition, that's discounted to the beginning of year 6. Okay. So this is the value from the beginning of year 6 going forward, present valued, because year 6 is already discounted. But I got to put that in today's dollars. So I got to discount that back to today. So I'm going to use the same discount factor equals as 2029. And I'm going to multiply it equals year 6 value times discount factor to bring it to a present value of 3.4 trillion or 34 trillion. Okay. You might say, gee, why did he use the same discount factor as 2029? Common mistake, because 2030 has already been discounted, right? It was discounted by the perpetuity equation. So if I discounted 2030 again, I would be double discounting 2030 and have the wrong answer. So that's why we're using the 29 discount factor, because basically this brings us back to January 1st, 2030, which is the same as December 31st, 2029, for all intents and purposes. When I add up these two values, I get the operating value of Nvidia, which equals the 1.4 trillion for the first 5 years, the 34 trillion in continuing value. I get an operating value of 35 trillion, 656 and change. So that's the operating value of Nvidia based on its forecasted free cash flows. Continuing on, we then add in the non-operating value, going back to Modigliani-Miller. The non-operating value will come from the TFI. On the TFI, we have labeled 3 non-operating items: excess cash, non-operating assets, long-term investments. Those are the non-operating things that have to be valued. So on our DCF equals from the TFI, A10 copy to down to A12 off the TFI. So those are the 3 non-operating assets and liabilities. Now, we're going to actually use the 2024 last reported year, which is already in a present value. So what is the current excess cash Nvidia has? From the TFI, G10. So today's excess cash. What is the non-operating assets Nvidia has? From the TFI, G11, and long-term investments equals from the TFI, G12. So 2 things. 1, these are already in present value. And 2, you might say, gee, why aren't we using a future number? The answer is we generally invest in companies for their operating items. I invest in Nvidia because they're really good semiconductor players making chips. They're not good at non-operating things. Generally, companies are not good at non-operating things. By definition, it's not what you do for a living. Like, you're not good at managing cash. You're not good at, that's what a bank does. It's not good at making non-operating asset investments. It's not what you do to make your products. So we assume that those are NPV 0 in the future. That's just an implicit assumption we're going to start. So that today's value is the future value for non-operating assets, meaning cash is worth $25 billion today, rounding off. Non-operating assets are worth $8 billion today. We're not going to assume that they grow in the future to be anything NPV 0. The one exception to this is long-term investments. Think back to my Microsoft example. If Microsoft invested in OpenAI and OpenAI becomes worth exponentially more, that's something that I might adjust. Okay. But typically, most companies, when they make long-term investments, don't really earn a lot of their long-term investments. So we often assume NPV 0, but we can always adjust this. So if we add up all these three, that becomes the non-operating value of Nvidia, which is the sum of these three, D13 to D15. Enterprise value is the operating value, which is D11, plus the non-operating value, which is D17, 35, 689, 681.79. Decimal place. It is this enterprise value which we distribute to the debt and equity holders. If we pay off all the debt and all the non-common shareholders, what we're left with is the common equity value. So what are the debt holders that had to be paid? Again, this is where TFI helps us. Equals TFI. We had to pay off retirement-related liabilities. Equals TFI. We had to pay off interest-bearing debt. Next, equals TFI. We're solving for common equity, so we'd have to pay out the preferred shareholders, and TFI, the minority shareholders. Those are the four stakeholders that get paid back in front of the common shareholders. What do we owe them? It's what we owe them today. Retirement-related liabilities equals TFI 2024 G15. Interest-bearing debt equals TFI G16. Preferred shareholders, if they had any, equals TFI G18. And minority shareholders equals TFI G19. So if format this to one decimal place, if we paid all the non-common equity holders, which in this case is really the interest-bearing debt, what we'd be left with is a common equity value, which equals the enterprise value minus the sum of those four items. That would leave a common equity value of 35.7 trillion. If I divided by the shares outstanding, I would get a forecasted share price. Now, the shares outstanding is actually something that's going to change company by company. So I don't want to put a hard-coded shares outstanding on this tab. So I'm going to put shares outstanding on the assumptions tab as our next assumption down. And that's going to be yellow. So now the question is, where do I get the shares outstanding?
Bloomberg.
Great answer. So Bloomberg makes our life a lot easier. And on one of their screens called security description, they have a handy dandy quick reference to the current shares outstanding for a company right here. which for Nvidia, 24.6 billion. That's the current share count for Nvidia. Right there. So I have put 3 screenshots that we're going to need from Bloomberg to get more realistic data into the files folder in week 4. There's that DES screen. I took a screenshot of it earlier today. So that's the screenshot that I'm referring to. Okay. I'm going to do 2 more screenshots that I'll talk to you about. Those are these 2. But we're going to get these 3 screens worth of data to make sure we have a current model. And so one of the pieces of data we'll use off the DES screen, there's going to be 2, is the share count. So that I have put into this cell. So again, the number was 24.6 billion. So 24,600. Our models in millions. That comma. So DCF valuation equals that assumption. Share price equals equity value divided by share count. Their share price would be $14.50 a share if all these numbers came true. 10 times what they're worth today, but it's not realistic. We're going to make it more realistic in a minute. But what's more important is we've basically said, if our model comes true with the ratios that forecast those cash flows, this is the value of those cash flows at that way. That's enterprise DCF from a process standpoint. Did everybody get to the share price? Because that's where you need to be before we go to our next step. Great. All right, let's start making this model, which can be used for any company, a little bit more realistic. Here's our next step in our process. I need assumptions to have a more recent WACC. 9.9 was a random number that we started with in the model. I need a current WACC for Nvidia. So Bloomberg, WACC. Here is today's WACC for the company. I took this as a screenshot. It's called Nvidia-WACC. Today, 13.8%. So Nvidia's current WACC, as estimated by Bloomberg, 13.8%. Notice when I change that WACC, share price $797.53. So the model's dynamic. As we start changing assumptions and ratios, the cash flows change, share price changes. What we're about to do is we're going to create our first valuation model, file, save as, and I am going to call this the Nvidia as is. And that is language that we will use in this class. Make sure I'll save this. That what this represents is we're going to try and model out Nvidia's current share price so that our share price in our valuation model exactly matches the share price in the real world of Nvidia today. Today, Nvidia closed at 122.59 a share. Okay, that's our last price. So 122.59 in our model, assumptions, next assumption down, current share price. We will get this off the DES screenshot in yellow. And again, screenshot I gave you today, 122.59. So there's two numbers you're going to get off the DES screenshot. You're going to get the share price, which is at the top of the screen, current share price of the company for as is. We're going to put that here. And you're going to get the share count. Okay. So again, here, pull up DES, share price. And then down here, looks like you got kind of squeezed. Share counts there. I might have to redo that screenshot because it got a little squeezed when I took the screenshot. But anyways, share price screenshot. All right, questions? I'll do a better screenshot of this next time. So our goal is to match the share prices. Now, in order to do this, we're going to start adjusting these ratios to be more realistic. Okay. So because I don't want to keep jumping back and forth constantly in my model as I change the ratios, what I'm going to do is I'm going to put the current share price on the ratios screen and the model price on the ratio screen. Meaning from the assumptions equals B9, which is what I want to match, and the model is DCF valuation D30. So our goal in the as-is model is to match these two numbers. So whatever the current share price is, our model needs to reflect it. That's called an as-is valuation. So what are the assumptions and cash flows that lead to Nvidia's current share price? Obviously, our assumptions are too high right now. We need to be more realistic. So what we're doing is no different than what Wall Street is trying to do. And as I told you, there's a group of people called the sell side analysts. These people who sell their models, and they're trying to do the exact Excel work we are. Probably a little bit more detail, but conceptually the same thing. So Citi, for example, this team at Citi or Webbush or whatever is building models, which they're selling of the Excel models, and they're uploading them to Bloomberg. As I told you, what Bloomberg is doing is it's aggregating and averaging the models. So even though you can't see an individual model, you can see an average of all the uploaded models, and that's called the consensus estimate. This consensus estimate, can't speak tonight, is the baseline, plus or minus a little bit, that Wall Street is using to value Nvidia in the future. So this is the forecast for the next 4 years. I don't think we're going to do a better job than the professionals right now of forecasting the next 4 years worth of revenue for Nvidia. So we're trying to estimate the current share price. We're going to use the consensus. So we're going to use the consensus, which comes from the EEO screen in Bloomberg. And so we're going to put the consensus into our model. Okay. This is what somebody earlier in the class had already started to do. So starting with revenue, we need to put these revenue numbers into our model. Now, here's how we're going to do it. On the assumptions tab, we're going to start putting in row 12, consensus, spell right, revenue. And the first year equals current year plus 1 is the first forecast year, 2025. And then starting in column C equals B11 plus 1, 2026. And we're going to do a consensus all the way through 2030 for the next 5 years. Paste. Or sorry, 2029, 2025 to 2029. And we're going to put in the consensus EBITDA. And that's going to get us the EBITDA margin. These numbers will be in yellow because they're coming directly off of the EEO screenshot. So in 2025, revenue today, 120,473. Twenty 26 revenue, 163,892. 2027 revenue, 191,254. 2028 revenue, 225,411. 2029 revenue, 264,680. EBITDA starting in 2029, 148,839. 2028 EBITDA, 137,154. 27 is 130,134. 26 EBITDA is 111,467. And 2025 EBITDA forecast is 78,923. These so our EBITDA margin is the EBITDA divided by revenue. So the consensus EBITDA margin is 65.5% in 2025. And by 2029, EBITDA margin is expected to be 56.2%. So that is the next 5 years of consensus estimate for revenue, EBITDA, and therefore EBITDA margin. Questions about where any of those numbers came from or how I calculated them? Richard?
This is more of a question on like how Bloomberg Terminal calculates the consensus figures. Would you consider that any other competitor to Bloomberg, like they don't have that amount of, like, let's say Citibank, they're only going to upload their data to Bloomberg, but they're not going to upload it to a competitor of Bloomberg's? Would you say that Bloomberg still owns that dominant, you know,
There's another
share, or
data
not dominant
service,
share,
I
but
forgot what's called, like Fiserv or something like that, that the analysts will also upload to. But the thing is, you need the sell-siders to be providing their data for the consensus. Because if you don't have
Mhm.
the sell-siders providing their data, then the estimates are less meaningful.
Okay.
And so there's a couple of data services. Bloomberg's not the only one that they'll provide the data to, but Bloomberg is one of them. And so as a system of
Mhm.
record, it's easy to just go there to get the consensus from the sell siders. Because I'm just saying, some data services
Got it.
might actually say, oh, I'm just gonna take some random professor at NYU. So you gotta be careful about where the consensus come from and how are they getting it? And so, I mean, it's right or wrong, but these are the people who are selling the research, as I said, that go back to that the institutions are paying attention to, because they're the ones that are, for example, unmuted on the conference calls. So they're the more critical analysts, and so their forecasts tend to carry more weight. Now, as you can see here, even in the share price calculations that their models are creating, their values are all over the place. Because this is going to have a higher DCF than that, which is going to have a higher DCF than that. So these three DCFs are slightly different. So the only thing that Bloomberg is doing is just averaging them. Kind of a wisdom of the crowd approach. But that's why I said it's like a baseline. Now, the baseline doesn't mean it's always right, because there's differences. This person is obviously more bullish on Nvidia than that person, right? But nonetheless, we're looking at an average of what the professionals, there's a lot of them for Nvidia, 74 of them, but what the 74 people are guessing. But I'm telling you, the average person's not going to get this. Goldman's forecast for Nvidia, you have to pay for it. They do not put it out there for free. And it's not widely circulated. And because of Goldman's, who they are, that's going to be an important forecast. And so having access to that is helpful. All right, back to our model. Other questions about what we did in the model? This is the important next step. We're then going to take in our as is, we're going to take these revenue numbers, have to become these revenue numbers. These EBITDAs have to be these EBITDAs. Okay, so here's how we're going to do this. Ratios. EBITDA as a percentage of sales starting in 2025. H7 equals assumptions B14. 2026 equals assumptions C14. And I'll just copy this over to 2029. So those, which I'm now going to take these 5 years and take out the yellow, are basically the consensus EBITDA margins that are coming from the sell side analysts. I need to do the same thing with the revenue. Now, to get the revenue, I need the growth rates. So what I'm going to do is I'm going to solve for the growth rate that equals the consensus. The formula for percentage change is current year minus previous year divided by previous year. So for 2025 revenue, percentage change equals left paren, current year. That would be current year revenue, 2025, is assumptions B12 minus the previous year's revenue, income G3. So current year revenue minus last year's revenue divided by last year's revenue, income G3. So the market's expecting Nvidia's revenue next year to grow 97.7%, which would get me to 124.73, which is the consensus. So we're just backing into the growth rate that gets me to the consensus. I'm going to do that for 2026. Equals current year revenue forecast for 2026, assumptions C12, minus last year's revenue, 2025 revenue is B12, divided by B12. Growth rate next year, whoa, what did I do? Equals current year minus previous year divided by previous year. There we go. 36% growth rate next year. 2027 equals 27 revenue minus 26 revenue divided by 26 revenue. Basically, they're going to grow 17%, 16.7%, 27. And since those are just going to be similar structure, those are the next 2 years of growth, 17.9 and 17.4. 28 to 29. Those are the growth rates for the next 5 years, assuming that the consensus comes true. No fill. Those are the EBITDA margins for the next 5 years, assuming that this consensus comes true. If that does come true, my share price, $41.72. And today they're trading at 122.59. We're not done, but we're a heck of a lot closer than when we started 30 minutes ago. Questions about what we just did?
I'm so sorry. Do you mind going back just to look at cell I3 on ratios?
Current year minus previous year divided by previous year. Assumption C12 would be the 26 revenue. Assumptions B12 would be the 25 revenue. Divided by assumptions B12, 25 revenue. So it's that formula just being applied 5 times. And I'm driving off the assumptions tab. So I'm backing in to match it exactly. Travis?
Hi, in your assumptions tab in column F, I just wanted to see those numbers again. I didn't catch them. The screenshot is cut off.
Yeah. Again, when you're doing your assignments, I'll make sure that you have 2 screenshots, which give you the extra row.
Thank you,
Now
appreciate it.
match the video. Ahmad?
So I guess my question is, once you started putting in the consensus of like the EBITDA and the all those other consensus assumptions, would IDCF technically just go back to what the price is today, or what the stock price currently is today?
Well, that's what we're trying to do. We are trying to put in the assumptions that lead to the current share price. We're trying to manufacture in our model a representation of what must people be thinking that leads to the current share price? What cash flows lead to the share price? That's called the as is.
Got you. Okay.
And by the way, this is a step most people skip in the real world. They go right to one of the next models we're going to do, which is what do we think it's going to be going forward? Like, what's our opinion?
Got you.
The
Okay.
opinion might be different than this current share price, and that's okay. But I think it's a useful step, as you'll see this semester. We're going to always model the current share price first, and that's called the as is.
As is. Okay. Because I was going to ask you, which you kind of already alluded to, was like when analysts make predictions on how far, like maybe say a 5-year cash flow, whatever thing like that, is that based off of what you have as is, and then what is that comparing the as is to what is going on
This is
further?
called the target. So what you do is you look at your as is, today's share price. You look at your target, that creates the buy, sell, hold opinion. Because if your target is within 10% of the current share price, it's called a hold.
Got you.
Here's a target of 120. Like, if I think it's worth 120 at DZ Bank and they're trading at 122, I'm not going to tell you to buy the stock. And I can tell you sell the stock. It's hold. Plus or minus 10% of the current share price is the usual range for a hold. More
Okay.
than 10% is a buy. Less than 10% of the current share price is a sell. Buy, sell, hold.
Got you. Okay.
It gets pretty straightforward. But in order to get the buy, sell, hold, you got to come up with what you think the share price is really worth. That's called
Got
the
you.
We'll
Okay.
move to next.
Okay. Okay.
But great question. And so you're being prescient about where we're heading with this. Matter of fact, we're going to always create 4 Excel models for every assignment. The as is, the current share price, the target, what we think it's going to be, what we think it's worth, and then we're going to do a bull and a bear. How high can it reasonably go? How low can it reasonably go? What's the range? Okay, and your target somewhere in the middle of the range. So that's what we're eventually going to do, but we got to finish the as is first. But we're getting there. So let's go back to the as is. And I'm assuming I'm sharing my desktop. So as I'm jumping back and forth to Bloomberg, you're seeing all this now, right?
Yes.
Very good. So here's where we're going to try and simplify a couple things. Nobody really asked me, but do you see these three things that are in gray over here on the ratios? The reason why is because those are the three most important income statement items to forecast free cash flow. Because revenue, EBITDA, and tax rate are the key drivers of gross cash flow. And operating value is really critical to forecast for any company. So we need to know the operating free cash flows. And this is what's critical to gross cash flow. We have forecasted two of the three items that drive gross cash flow. We forecasted revenue and we forecasted EBITDA. The third one, we need a realistic tax rate for Nvidia going forward. Okay, so what will their average tax rate be in the future? Clearly not negative 4.5%. No one's going to pay 1% forever. What's a realistic tax rate for Nvidia going forward? Okay, two ways that you usually get this. One way is companies provide guidance and they'll guide the market. They'll say, here's where our tax rate is expected to be going forward. Nvidia has provided tax rate guidance going forward that it should be in the 16 to 18% range. Okay, so we need a realistic tax rate for Nvidia going forward. The company said 16 to 18. Where in that range do you want to put the tax rate that we use? How many numbers should we use?
The middle.
All right, that seems very reasonable to me. So let's use 17. I wouldn't use 25 and I wouldn't use 11. So they say 16, 18. I think they have a good idea. Let's use 17. But you could use 16 or 18. But for our purposes today, we're going to use 17. Notice when we put in 17, starting to 2025, that carries in for the future, that leads to a share price of $39. The next number that we have to forecast that's going to be very important is the balance sheet ratios as a percentage of sales. Okay. Now, this is where this number comes into play. Okay. Invested capital sales is balance sheet productivity. 0.35, which is where they were, means that every time we grow $1 of revenue, the balance sheet grows 35 cents. Because all of these ratios are a percentage of sales, then the balance sheet automatically grows as ratios grow, as the revenue grows. And so that's the second reason why everything's a percentage of sales, because it basically grows the balance sheet with revenue automatically at these common ratios. Now, because the revenue is growing faster, our productivity will eventually go down to 0.28. So what we have to decide is, will Nvidia get an economy of scale and have revenue grow faster than assets? Or are they going to kind of maintain their current productivity in the future and use 35 cents? If I think that they're going to maintain their productivity at 35%, then I'm going to have to start upping spending, for example, on PPD to sales or accounts receivable to sales to get this number to 0.35. If I do believe that all their growth in revenue is going to be an economy of scale, then I could leave these numbers alone. Right now at Nvidia, just given how fast their margins and growth rates are growing, I actually think they are getting an economy of scale. I don't think they need, because they're getting basically more out of every chip that they're selling. They don't need to build more fabs to create more chips. Now they're doing that, but I think they're getting an economy of scale. So I actually think the improvement in productivity is okay. And for most companies, you're not going to muck around with the balance sheet ratios. And the reason why this is going to be done is change in balance sheet, is gross cash flow, gross investment, So the model will automatically create your gross investment and therefore your free cash flows. So leaving these ratios leaves the productivity the same, but that still creates the gross investment. So what really matters, 90-10 rule, 90% of our valuation is getting these three numbers right. Okay. We have a reasonable revenue growth rate for the next 5 years, reasonable EBITDA for the next 5 years, reasonable tax rate for the next 5 years. The last one is the perpetuity period. What's reasonable into perpetuity? Okay. So the 1-year growth rate in 2030 doesn't matter as the long-term G. That's what's going to matter. What's our G? So we're going to be the last number that we're going to do. What do we think the margin needs to be? And what do we think the tax rate needs to be? Tax rate, okay, 17%. I'll leave it for now. Although to be honest with you, depending on who wins the November election, the view on long-term tax rates might change. Okay, because there's one party who says 28% for corporate tax rate, and one party says they might even want to cut it further. Okay, so who's in the White House could affect valuations because it will affect tax rates, right? But nonetheless, for now, we're going to leave it at 17%. I'm going to assume that Congress will be paralyzed no matter who wins, and tax rates will probably stay the same. That's an assumption we're going to make for this class. Chris.
Would you move that assumption, or would you move that tax rate over to the assumptions tab?
We could, but as I said, if I change the White House, I might change the tax rate starting in 26 or 27. So
Okay.
I could, I'm leaving the model this way for reasons that we could change it, but practically you could move it to the assumptions tab because we're not really changing the tax rate in this class for simplicity.
Okay.
Now, you want to get complex in your teams, have at it. But trying to simplify a few things here since we only had 7 classes this semester. But it's a great question. All right. In the interest of time, just kind of finishing up here. In the 4th section of the class, we're going to talk about multiples. And one of the things that we're going to learn in multiples is hidden in the multiples is the long-term EBIT forecast for a company. Okay. So for now, trust me, in 2 weeks, the book and I will talk to you about where these numbers are coming from. But if we take our enterprise value to revenue multiple, and we divide that by the enterprise value to EBIT multiple, we get a perpetuity EBIT margin. So on the EEO screenshot, here are the multiples for Nvidia in the future based on the current share price. So their EV to revenue, basically for every dollar of revenue, what's the total value of the company in the market? Enterprise value divided by revenue. In 2025, 2026, and 2027, it is 37.9, 26.86, and 23.01. When we get to the multiple section, these 2 years become more important to professionals because these are clean forecast years, meaning 12 clean months of forecast, 12 clean months of forecast. Nvidia is halfway through 2025. So half of these numbers are actual, half of these numbers are forecast. So numbers tend to normalize when you do complete forecast years. Simplifying for now. So long story short, we care about these 2 numbers. EV to revenue in 2026, 18.28. So $1 of revenue creates $18.28 of value. In 2027, EV to revenue is 15.66. $1 of revenue creates $15.66 value in 2027. EV to EBIT in 2026. EV to EBIT 2026, called year 2, year 3, year 1, 2, 3, is 27.73. and 24.44. Which suggests, these will be yellow, that the perpetuity EBIT margin that has to exist in the analyst spreadsheet on Wall Street is that divided by that, or somewhere between 66%, 65.9, and 64.1. Translation. Perpetuity EBIT margin is this row, which means this number, based on the current share price, needs to be between 64.1 and 65.9. That's the only way you can justify the current share price with those multiples. So we need our model to reflect that. We need an EBIT margin 64.1 to 65.9. Right now it's 53.8. And that is a white cell, which means I can't change it. So the way I change M9, which is EBIT margin, is I change my EBITDA. So I need to change my EBITDA so that that number is between 64 and 65, 66, call it. So let's say I want to get it around 65. I'll go for the midpoint. That means that this needs to be 67.5. So at a 67.5% EBITDA margin in perpetuity, which is what the trading multiple suggests, I get a 65% EBIT margin. And oh, by the way, that gets me to a share price of 45. And right now they're at 122. Does everybody understand what I did conceptually? Is the trading multiples to estimate the long-term EBIT margin. But since I can't change the EBIT margin, I change the EBITDA margin to get my EBIT margin. Final step. G. We put in a placeholder of 3%. Clearly, Nvidia is growing much faster than 3%. So what is a realistic G? What we're going to do is we're going to solve for it. Since we've kind of put in everything else that we think is realistic, we're going to solve for the G. How do we do that? Data, tools. We're going to goal seek it. So what I'm going to do is I'm going to set the cell current share price D30 off the valuation tab to the current share price 122.59, and I'm going to tell Excel to keep changing assumptions B7 until that share price in that cell becomes 122.59. When I hit OK, the G for Nvidia is 10.73%. And at a 10.3%, 7.3% G, our model now has a 122.59 price. So our final step is to get a G that basically creates the matching share price. So forecast the ROIC, essentially, solve for the G, because the G is the most sensitive part of the model. And so therefore, we're going to back into it in our as is for the most part. Questions?
What cell did you select to change again for the goal seek?
Well, option one is I don't need to use goal seek. I can just start plugging in G's until the model matches. That's one option. But if I don't want to do that, I can have Excel do that for me. So that's where you go to Tools, Goal Seek. What you do is you say, set the cell you want to solve for. In this case, DCF valuation, the forecasted share price. So DCF D30. what do I want Excel to solve it to? I want it to create it to be 122.59. That's the value. And what cell do I want to keep changing until the share price becomes 122.59? I want to change assumptions B7. That's
Got
the,
it. Okay.
and then when you hit OK, what Excel is going to do is very quickly, it's going to keep iterating until it gets those two numbers to match. It's called goal seek. So I can do it manually, it's fine, but goal seek just is a little efficient. And I'm just telling you, goal seek doesn't always work. Every now and then Excel, you put this in, it kind of chokes, you got to do it manually, but most of the time it works. But what we've just done is we've created an enterprise DCF valuation model of Nvidia, which is fairly realistic. That says if these assumptions come true, then that's what leads to the $122 share price that they closed at today. That's called the as is. And this is next week's homework assignment. So if you've gotten to this point, you've completed the homework for next week. If you haven't gotten to this point, you have between now and next week to get to this point. Travis?
Hi, just because the screenshot is cut off, can I see that revenue number for FY29?
You're talking about the assumptions?
Yeah, yes.
Yeah. And again, this video has been recorded, so I will post this soon, hopefully by tomorrow morning. And if, by the way, even while you're waiting for it to show up on YouTube, you can always go to the Zoom, because in the Zoom cloud recordings link are the links to the videos. They come up there faster than I can get into YouTube. Niraj?
So I just had a question regarding the ratios tab, the M7 cell. Like, how did you get the 67.5%? Like
So for
in the ratios?
perpetuity, okay, which is
Yes.
this year is the beginning of our continuing value / perpetuity / terminal value, interchangeable numbers. So the idea is I need to know what the perpetuity value is. So it's not just the 2030 value, it's the very long-term EBIT and EBITDA margin, okay? I know, which is from multiples, that if you divide the enterprise value to revenue multiple by the enterprise value to EBIT multiple, mathematically, it gets you a perpetuity EBIT margin.
Right.
That's academic math in the book, which we haven't gotten to yet. Just kind of previewing this. So I know that that formula has to work. Given these observed multiples today for the forward years, I know that the EBIT margin perpetuity has got to be somewhere in here to value the company on a DCF basis. So what I'm doing is I'm saying, okay, if I know that that's the range that equals today's share price in perpetuity, then I need to get this number, which is that number, into that range. And I took the middle of the range at 65. But since I can't change it directly, the white cell, I changed the EBITDA to get in that range. Because that's a cash flow number, depreciation, non-cash flow. That's going to have an effect on DCF. So I changed the EBITDA to get to the EBITDA.
Oh, okay, yeah. That's why it subtracts and it comes down to 65%. Okay, understood. All right.
Yeah. So 67.5 is the depreciation, is the 65.
Right.
Now I could have used a 68% EBITDA. I could use a 66.5 EBITDA because I'm in that range. So it will slightly change my G. So
Okay.
I'm going to get, to some degree, a range of answers, meaning there's a range of EBITs margins and a range of Gs, somewhere around 65, somewhere around 10%. But that's about what the average DCF is probably saying, because that's the only way you justify this share price
Okay.
on a
Okay.
DCF basis. And that's called,
Okay.
and this is where you need to be.
Right.
Okay.
Yep.
Here's the point, and I'll preview next week. Part of the reason I did this transparently is I owned Nvidia. And in the run-up, I was trying to think like, should I hold on to it? And so selfishly, I had my undergrads in April, we did Nvidia, just like you're doing today. And I tried to answer the question like, what's the fair price for Nvidia? Like, when should I get out? And here's the point. This DCF, this as is, tells me that Nvidia has to hit these numbers to justify the current share price. Right? If they don't hit these numbers, then that share price isn't going up, it's going down. So right now they're here, which means they have to go from selling 61 billion in chips to 300 billion in chips by 2030. And on 300 billion in sales, they need a 65% EBITDA margin in 6 years. You guys just did an EIC, right? You did a 5 forces. So what I'm saying is that's the $120 something share price. So if they're going to hit that price, they got to hit these numbers. And if they don't hit these numbers, then there's downside risk to Nvidia that people have overvalued them. So we start thinking about our target share price. That's the point. You think Nvidia is going to have a higher than 120 share price? You think it's worth 150? Well, they got to beat this. So that's the idea of the as is. And then we'll get a target valuation next week, and then the bull and the bear. But nonetheless, that's mathematically what's happening. Questions? William?
Thank you.
Yeah, you pull down all of the data that's in the model data tab from Bloomberg, right?
Correct. This is model data is historical data. I pulled 6 years of historical income statement and balance sheets. Not in a nice looking format, just raw data
And then did you
for database.
like is the format that it comes out of Bloomberg like this? Or you had a
So,
format?
so what happens is in Bloomberg, historical data called FA, and these are the historical income statements. Okay. Now Bloomberg puts them into an adjusted format to help the analysts. Okay. So here's the Bloomberg adjusted statement for Nvidia. Okay. As opposed to the GAAP one that the company reported. So this comes right out of the 10K, but to help, they adjust all the semiconductor firms in a common format and take out one-time items. But what I found is when you go across companies and when you go across industries, these adjusted statements have slight differences. So we couldn't build a model on the adjusted statements because the adjusted semiconductor statement is different than this adjusted retail statement, which is different than the adjusted airline statement. And so we needed something that works for all of them all of the time. So what I had to do, and I've done over the years, is I said, what are the recipes, the raw materials that lead to these adjusted statements? That is this file. Here's all the items that went into the adjusted income statements, all the items that went in the adjusted balance sheets, all the items that went in the adjusted cash flows in raw format. Just reverse engineered. Export Excel. That's what I gave you. So the point is, the adjusted statements in Bloomberg might change for company to company, but the standardized statement that we've created in our model does not. And these are the things that lead to the standardized statements. That makes sense. But the nice thing is that when you do company number 2, Delta Airlines, there's Delta's historical data, file export. I give you this file, you put in our model, you got Delta's historical data in our format with all the TIIs, TFIs, CFIs. Spencer?
Gotcha. Yeah, so that model tab that you're showing right now is something you made.
It's something we created in these classes here at Maryland. Yes. Bloomberg does not give you this. They don't give you a standardized statement, which is sad because I was like, where's your standardized statement? They have like 5 different ones. So how can you have a standardized statement when you have like 5 different standardized statements? And so we needed one that went across industries. And so since Bloomberg doesn't give you one, we had to create our own.
Do we get access to that as students?
You can. The only thing is to access it, you need a terminal. Because otherwise you can't export the standardized statement. But you can get to a terminal, I'll give you the template. Like in the undergrad version of this class, they actually all work at terminals the whole semester. So they actually build this themselves. So they all have these. So it's not that I wouldn't give it to you. It's just, you can't give it to you if you don't have a terminal. That's why this is tied to Bloomberg.
Yep, makes sense. Thank you.
But last thing I want to show you, and we're about done, is we'll go back to this valuation model. I told you this at the beginning of class, and you can kind of visualize this now in the DCF valuation. This is the real value of Nvidia today. They're worth about $3 trillion of operating value. In the first 5 years, the free cash flow is worth 284. In perpetuity, 2.7 trillion. The perpetuity is more important than the next 5 years. The 2.7 trillion, year 6 and forward, is basically these 4 numbers. These 4 numbers drive almost all the value of Nvidia. That's what I'm saying. Like, that's the one challenge with these DCFs, is that when you go to terminal values or continuing values, you don't want to have a lot of uncertainty about what those values are, because if there's a lot of uncertainty about those values, then that continuing value could end up being way, way off. I'm not saying there's not uncertainty with Nvidia, but I'm saying that that's the whole point. That's why you want to have a company that's in a more stable state. Because these early growth companies with a lot of uncertainty about their future cash flows, your continuing values can be all over the place. And right now, that's called Tesla. Non-operating value for Nvidia, trivial. 32 billion. It's a rounding error to the 3 trillion of operating value. But this is their share price today. 3 trillion of enterprise value, 24.6 billion shares. That's the 122.59 share price. All right, so this is called the as is. This is your homework assignment. So as I said, that file matching everything we just did up to this minute is what you need to turn in. If you've done that, you finish next week's homework. If you haven't, you have until next week to get to that point. There will be a video posted by tomorrow morning to match, help if you struggled with anything to do that. And the other thing is, I saw several of your teams had started to give me some companies. So let's just go back and clarify the companies that we have. So I get all the companies in here. And then we'll end. So, people, teams. All right, who is Chipotle? What team wanted to do Chipotle? Hello? I know one of the teams sent me something that said they wanted to be Chipotle. All right, I'll go a different way. So team 2. Zach, Christopher, Tyler, Logan, Theodore, did you pick a company?
No, we haven't yet.
All right, so here's the deal. By Friday, teams 2 through 7, pick a company. You can't do Nvidia or any other company I'm doing an assignment on this semester. So maybe it was in the other class I'm doing tomorrow night with the online MBAs, but like somebody doing Chipotle, right? If somebody does Chipotle, you can't do Chipotle. You can do McDonald's, but you don't have to do that. You could do Delta. You know, I think somebody said Peloton in one of the other class. So you need to pick companies that are publicly traded. I'd suggest bigger ones. Don't try to do some small biotech that's a startup. That's going to be really hard to figure out their future. But that's going to be your team semester project. So I need to know who they are. So send me an email, and as you give them to me, I'll start updating this screen with the companies that you picked. Can't duplicate.
I think Taylor
Not
Magnolia
sharing, so let me go
submitted.
back to sharing. Sorry, I'm talking about this screen. So you're on a team, you're on one of these teams. Each of these teams, pick a company. That's going to be your group project for 40% of your grade. So just, we did a valuation of Nvidia, you'll do a valuation on whatever company you pick. All right.
I
so I'll
think we
call-
submitted Peloton.
your
I think we
Peloton-
did. I think we
Which
did
team?
submit Peloton.
Do you remember which team you were?
Should be 7, I believe. Is that right, Claire?
Is that-
Yeah.
Yes,
Yeah,
Taylor
there's a-
Magnolia sent something in.
All right, thank you for doing that. All right, so this is the team that did Peloton. I know somebody sent some in. Anybody else send one in?
Team 8 probably just sent one today. We're doing Adobe.
So, change my
And,
screen.
Team 6, it's Royal Caribbean.
Team 7 is Peloton.
Yep.
Yes.
Peloton. Team 8, you were who?
Adobe.
Adobe. All right, and team, who's Royal Caribbean? Team what?
Team 6, Royal Caribbean.
Team 6, RCL. Anybody else?
Professor, I was with Team 3. We had a question because we talked about doing Rivian, but they went public like 2 years ago.
It's gonna
so we
be
don't know if
hard.
there'll be.
I'm not saying you can't do it, but I'll tell you, that's hard. And I would go with somebody easier.
We'll brainstorm here after the class and get
I'll
you
give you
something
guys
by
till Friday. For the other 4 teams, send me an email by Friday. I'm just saying, don't pick somebody that just went public. They're not gonna have a lot of history. They're gonna have a more uncertain future. Not saying you can't do it, but I'm telling you, it'll be a little bit more of a challenge. Now, you guys want to do challenge, it's great, but it's 40% of your grade. And I'm gonna grade you the same as somebody else doing Royal Caribbean. So
10-4.
just give me it.
We'll get back to you. Thank you.
All right. Well, we're past time. Thanks, everybody. Sorry for starting a couple minutes late. We'll see everybody next week. Have a good night.